What has been the story for utilities over the past half year?
I think the biggest story for the utility space has been the peak in the interest rate rising cycle. And our speculation back in November was that we were nearing or at a peak in the interest rate cycle, and that really has come to fruition. What we've seen is a slowdown in the U.S. economy. Higher interest rates are having the intended effect, and that's bleeding into a slowdown in the inflation story, which is really what's most impactful for the interest rate markets and for utilities in particular as a defensive, yield-sensitive sector. We've been trading off that, and we've had some pretty good performance in the utility space. Now, the market is concentrating on what we've seen so far, which is a soft landing narrative, and that's generally a very good backdrop with an easing cycle for stocks, and utilities will benefit from that as well. Now, they may lag a little bit on the upward performance in a bull market, but you get the defensive characteristic when you're investing in utilities. So if the U.S. economy does slow down, we enter into more of a harder landing, which again is not our base case. You do have that defensive characteristic investing in utilities. So beyond the macro story, I think looking forward, there are a few other key themes that we're looking at, and the biggest of which would be the AI demand and AI power story.
How is the development of AI impacting the utilities sector?
I think on net, it's going to be a positive story for the utilities sector. For example, we look at an interesting study from the Electric Power Research Institute. They highlighted that a ChatGPT search is actually 10 times more power intensive than a traditional Google search. And so, with the whole world moving towards AI and implementing AI for new business lines or, making, business more efficient in some way, it has big implications for electricity demand. And we look also additionally at a Goldman Sachs research report where they've suggested that in their forecast, data center power demand is actually going to increase by 160% now by 2030. And if you translate that into what does it mean for overall U.S. power demand, their previous forecast had the U.S. electricity demand growing by 1.7% compounded annually over the 2022 to 2030 period. They now suggest that that's potentially as high as 2.4% per year. And that's a pretty big abnormal spike in electricity demand in the U.S. and something that we haven't seen in any recent history. So I think that's positive for utilities, and it's not just in areas that were traditionally data center focused, like Virginia and Texas, where data center power demand has really been increasing a lot. The EIA data suggests that it's also areas like North Dakota, Arizona, and Utah as well that are seeing increases in commercial electricity demand. And so I think by broadening out of this utility story, it will be beneficial for many utilities, especially in the U.S. And it's not just electric utilities. We're also seeing the same thing for natural gas demand. So the pipeline segment of utilities as well should see some benefit from the theme of AI and data center growth. And again, it's not just a U.S. story either. It's Canada, but then also Europe as well, because Europe has 15% of the global data center market. And so with the similar dynamics happening there, I think going global with utilities exposure makes a lot of sense.
What are the advantages of a global utilities portfolio?
I think probably the biggest advantage is really helpful in diversifying out many different types of risks in the utility space. I think the first one that comes to mind is the market risk. By investing in different exchanges around the world, each moving sort of potentially in different ways at different times, you diversify out by having exposure globally. I think also investing globally as well, you have different exposures to different interest rates in different countries around the world. And that has big implications for a yield-sensitive sector like utilities, both from a valuation perspective as well as fundamentally as these are highly leveraged entities. And so I think going global helps to diversify some of that interest rate risk out as well. I think additionally you consider, these are big fixed in place assets, and so, you have the risk of a natural disaster, and so by diversifying out geographically, you help to mitigate some of that risk. And I think finally, the regulatory risk would probably be one of the big keys. And by investing geographically and globally, you're helping, and state by state, you're helping to diversify out some of that risk. You're flattening out your exposure to any one political or regulatory regime in any one state or any one country. And I think that's really a really key focus for not putting all your eggs in one basket in the utility space.
Subscribe to Harvest ETF's Insights. Join us and stay informed.